You know that feeling when you check your portfolio during a market correction?
Oh, yeah.
I'm talking about a real sea of red day. You
Yes.
open the app and you're hoping, maybe your tech stocks are down, but your utilities or your international funds,
Oh,
they're holding the line.
the flight to safety.
Right.
Correct.
But instead, you see that everything, I mean, absolutely everything, is down 3%.
Mm-hmm.
And it doesn't matter that you spent hours picking these so-called uncorrelated assets.
Mm.
The moment panic hit, your entire portfolio just started moving like a single terrified animal.
And that is the correlation breakdown.
Mm.
It's the dirty little secret of diversification.
How so?
In a real crisis, correlations tend to converge to one. So all those different baskets you so carefully packed, well, they turn out to be the same basket, just painted different colors.
Which I think brings us perfectly to today's deep dive.
Mm.
We are looking at a paper that basically says, stop buying more baskets.
Yeah, it's more like, maybe you should burn most of the baskets you already have.
It's a really radical approach.
It is. It's an approach based on subtraction. We're digging into a very fresh piece of research. It's from February 2026, titled A Novel Approach to Portfolio Construction.
By DiMatteo, Riso, and Zoya.
And they're proposing this new machine learning framework that feels incredibly uncomfortable for anyone raised on traditional investing advice.
We're talking about BPASGM.
The best path algorithm sparse graphical model.
Okay, that is a mouthful. Let's stick with calling it the spider web, or maybe just the algorithm for today.
Sounds good.
But the promise here is just, it's wild. It suggests that if you want true safety and better returns, you shouldn't own an S&P 500 index fund. You shouldn't even own 50 stocks. You should maybe own 3.
And that those 3, if you select them with this algorithm, will likely outperform the 50 while taking on, significantly less risk. It really challenges the entire more is better philosophy of modern passive investing.
Okay, so before we get to the machine learning magic and the way it picks those 3 stocks is fascinating, we have to establish why the current gold standard is failing us.
We have to talk about Harry Markowitz.
1952, modern portfolio theory.
Right, this is the bedrock of finance. If you have a robo-advisor, a wealth manager, a target date fund, there is some version of Markowitz running in the background.
The mean variance model.
The mean variance model. The idea is, it's elegant, it's mathematically beautiful. You want to maximize your return for a specific level of risk.
Okay.
And you do this by looking at how assets have moved in the past, their covariance. And you mathematically optimize the weights to find the so-called efficient frontier.
It sounds perfect.
Yeah.
So why does my portfolio still crash?
See, the flaw isn't in the math. The math is perfect.
Okay.
The flaw is in the reality. The paper calls it the finite-sample problem.
Which is just a polite statistician's way of saying we don't have enough data.
Exactly. Markowitz's model assumes the true probability distribution of future returns. Like the physics of a dice roll perfectly.
Oh, we don't.
In the market, we don't know the physics. We only have history. We have finite samples.
Okay, let's break that down.
Huh.
So if I flip a coin 3 times and it comes up heads every single time, a finite sample model would say.
It would say, okay, this coin clearly only produces heads. I will bet my life savings on heads.
Right.
And that's a perfect analogy. In finance, we have more than 3 coin flips, of course, but compared to the sheer complexity of the global economy, our data is still tiny.
So when you run a standard optimization on, say, the S&P 500, you're building this covariance matrix.
A giant grid.
Showing how every stock relates to every other stock. And that grid is massive.
It's massive, and it's full of noise, just random blips. Maybe 2 stocks move together for a month, just by pure chance. The Markowitz model doesn't know it was chance.
It sees a pattern.
It sees a pattern and treats that noise as a hard fact. It says, these 2 are linked. I will bet heavily on that relationship.
So the model is confident, but it's confident about a hallucination.
Precisely. And the paper argues that the traditional fixes things like shrinkage estimators or Bayesian adjustments, which are just fancy ways of smoothing out the data.
They're just putting lipstick on a pig.
That's a good way to put it. They try to dampen the noise, but they don't fix the root cause, which is that you are letting too many redundant, noisy assets into the calculation in the first place.
You're trying to optimize a messy room instead of just cleaning it.
That is the intuition, and that is where BPASGM comes in. The whole goal here is dimensionality reduction.
Okay, so that brings us to the spider web. This algorithm doesn't look at a spreadsheet of correlations. It looks at a graph.
Exactly. Imagine a detective's conspiracy board. You've got push pins representing every asset, stocks, bonds, currencies. The algorithm starts drawing strings between them.
But there's a key difference here.
A huge difference. It doesn't just draw a string if they move together. It draws a string if one explains the other.
And it does this using mutual information, not standard correlation. I think most of us know correlation. If stock A goes up, stock B goes up. Why is mutual information better?
Well, standard correlation is linear. It's a straight line. But markets are messy. They're nonlinear. Sometimes stock A goes up and stock B does nothing. But if stock A crashes, stock B crashes hard.
Correlation misses that.
It often misses that kind of nuance.
Yeah.
Mutual information captures the entire relationship, the linear stuff, the nonlinear stuff, all the hidden dependencies.
It sees the crash coming when correlation is blind.
It sees the connection that causes the crash, and it uses a best path algorithm to ask a very specific question for every single push pin on that board.
Which is?
What is the absolute minimum number of other assets I need to know to predict this one?
You used an analogy when we were prepping for this that I really liked. The rumor mill.
The rumor mill, right. So imagine a small town where rumor spreads. If you want to know who started it, you don't need to interview all 500 people in town.
No, because 495 of them are just repeating what they heard from someone else.
Exactly. If person A tells person B and person B tells person C, well, interviewing person C gives you zero new information. C is just a repeater. You want to find person A.
So in the stock market, if the whole tech sector moves, and Microsoft moves, and then some smaller tech supplier moves, that supplier is just person C.
In many cases, yes. Its movement is almost entirely predicted by its parent nodes. And this leads to the most important concept in the paper, the Markov property.
Specifically, something called Lemma 2.1.
Lemma 2.1.
Sounds serious.
It's the shielding effect. It essentially says that once you identify the parents, the direct predictors of a stock, that stock becomes conditionally independent of the rest of the market.
You've isolated its signal.
You have isolated its unique signal. You don't need to care about the rest of the web.
So the goal of this algorithm is to map out this huge web of market rumors, find the few loudmouths who are actually starting the conversations, and then just ignore everyone else.
Yes. It builds what's called a directed acyclic graph, a DAG. It's a one-way flow of information. And once it has that map, it starts the purge.
Okay, this is the part that stresses me out. The paper describes a three-step process that is just absolutely ruthless. Usually we think more tickers equals better diversification. This thing wants to fire 99% of the market.
It is subtraction over addition. Step one is the star and the cull.
How does that work?
You pick a star node. The paper suggests you start with the asset that has the best historical performance, so the highest Sharpe ratio or Sortino ratio.
Okay, so I find my MVP. Let's say it's a high-performing tech stock. I've got my star.
Now, the algorithm looks at the web. And any asset that is positively connected to your star, meaning they tend to move in the same direction, is deleted.
Gone.
Gone.
Wait, hold on a second. Even if those other stocks are making money, even if they're great companies.
Even if they are great companies, if they're positively connected, they're friends, they are redundant. If your star goes up, they go up. If your star crashes, they crash.
So they add risk without adding new information.
That's the logic. It feels incredibly risky, but the idea is that keeping the friends doesn't actually protect you. It just gives you the illusion of safety. The algorithm only wants to keep strangers, or even better, enemies' assets with negative connections.
Okay, so we've cleared out the entourage. What's step two?
Cutting direct links. This is for the survivors of the first round. Let's say you have two assets left, maybe a bank and an insurance company. They both survived the first cut.
Right.
But the graph shows a direct predictive link between them. One predicts the other.
So it's a standoff.
It is.
Yeah.
And the algorithm acts as the judge. It looks at their performance metrics, Sharpe ratio, variance, and it keeps the stronger one. The weaker one gets the boot.
And finally, step three, breaking the chains.
This handles loops. If asset A predicts B, and B predicts C, and C predicts A, you have a feedback loop. That's instability.
That's how you get market bubbles.
That's how you get bubbles. So the algorithm hunts these loops down, and it cuts the weakest link to break the circle.
Wow. So after this bloodbath killing friends, cutting links, breaking loops, what are you actually left with?
You are left with what the paper calls a chemically pure portfolio, a handful of assets that are structurally forced to be indifferent to each other. They are uncorrelated by design, not by accident.
But does it work? I mean, theoretically, this sounds clever, but if I'm holding just three stocks and one of them tanks, I'm not losing 3%, I'm losing 33%. That sounds terrifying.
That is the fear, absolutely. But the data says the opposite. They ran this on a massive data set. U.S. blue chips, global indices, currencies spanning from 1990 all the way to 2025.
Let's talk about the before picture. They call it the minimal BIC tree, but I'm just going to call it the hairball.
It really is a hairball.
Oh.
Before the purge, the market looks like a tangled mess of spaghetti. You see these huge clusters. All the tech stocks, Microsoft, Apple, Oracle, they're huddled together around the NASDAQ Q node. They are just screaming redundancy.
And the utilities are in their own little corner, the banks in theirs. It's extremely cliquey.
It is. But there was one fascinating outlier in that initial graph. The VIX.
The fear index.
The fear index, right. In the graph, the VIX was just sitting off to the side, sort of detached from the main positive dependency core. It was already signaling that it plays by different rules.
So let's look at the specific case study they highlight, the Danaher portfolio. This really drives the point home.
This is a perfect example. It started with Danaher ticker DHR as their star node because it had the best risk-adjusted returns in the training period.
Okay, so Danaher's the MVP. They start with a universe of 358 assets.
After step 1, just deleting the friends, they were down to 7.
From 358 to 7. That means 351 stocks were effectively just mimicking Danaher or whatever market factors were driving it.
Exactly. It just shows you the staggering amount of redundancy that's baked into something like the S&P 500. Then, after cutting links and loops in steps 2 and 3, the final portfolio was just 3 assets.
3. Who are the survivors?
Danaher, Cadence Bank, and the VIX.
A conglomerate, a regional bank, and the fear index.
Yeah.
That's the whole portfolio.
It sounds absurd, doesn't it? But here is why it worked. The paper uses a DCC-JAR-RCH model.
Okay, a fancy way to measure volatility over time.
Right, and it showed that the correlation between the VIX and the other two was consistently negative.
So when Danaher and the bank likely took a hit during a market panic,
The VIX spiked. It didn't just sit there, it actively countered the losses. And because the algorithm had stripped away all the other noise, the 350 other stocks that would have also been dragging you down, that negative correlation had this massive leverage effect. It stabilized the entire portfolio.
okay, this leads us to what might be the most controversial chart in the entire paper, the negative slope.
Yes, this is where traditional finance brains start to short circuit.
Yeah, because we're taught risk equals return. If you want more profit, you have to accept more volatility. The chart should slope up.
Correct. Higher beta, higher return. That is the fundamental law of pricing assets.
But in the BPASGM results, the regression line slopes down. The portfolios with the lowest volatility actually produced the highest returns. Did they? Did they break economics?
No, sadly, they didn't break economics. What they did is expose the inefficiency of the risk equals return dogma in the real world.
Okay, explain that. How can lower risk yield higher returns without some kind of magic?
Well, in a textbook world with infinite data, sure, risk buys return. But in the real world, a lot of what we call risk or volatility is just noise. It's inefficient thrashing. It's stocks reacting to rumors and echoes.
So high volatility doesn't always mean you're taking a smart bet on the future. It might just mean your portfolio is chaotic.
Exactly. A noisy engine shakes a lot, but it doesn't go faster. It just wastes energy. By using the spider web to strip out that chaos, all that redundancy, you aren't avoiding necessary risk. You're just avoiding unnecessary noise. You're finding this sweet spot of efficiency.
The paper mentions the diversification ratio.
Right. Think of the diversification ratio as a measure of how much bang for your buck you get for every unit of risk you take on. The math has the average correlation of your assets in the denominator.
And since this algorithm forces that correlation to be near zero,
The denominator shrinks and the whole ratio skyrockets. You're capturing pure return without the baggage of the market's interconnected mess.
but the real test, right, the only test that really matters, is the out-of-sample. It's easy to predict the past. How did it handle the future?
They tested it on unseen data from October 2024 to December 2025. A pretty volatile period.
Yeah.
They compared the virtual volatility, what you'd expect if the assets were truly random, against the actual realized volatility of the portfolio. And the actual volatility was significantly lower than the sum of its parts.
That is the holy grail. The portfolio was safer than its ingredients.
It confirms the VIX effect wasn't a fluke. The algorithm successfully identified a structural hedge that held up even when the market shifted regimes. I mean, visually, the volatility chart for the BPASGM portfolio is this smooth, low line, while the standard Markowitz models are spiking all over the place.
It's the difference between a cruise ship with stabilizers and a raft in a
Mm,
storm.
that's a great way to put it.
So let's zoom out. What does this all mean for the listener? Most of us are not going to go home and code a sparse graphical model in Python tonight.
Probably not. But the philosophy here is a game changer. It really challenges the ETF mindset.
The idea that just buying everything is safe.
Right. We buy the S&P 500 because we want broad exposure. But this research suggests that broad exposure is mostly just exposure to the same single factor repeated 500 times.
It's diluted.
It's diluted and it's synchronized. When the ship sinks, all 500 cabins go underwater together. BPASGM suggests we need to think about building a safe room first.
A safe room.
Before you even decide how much money to put where, you need to filter your universe of assets. You need to verify that your assets are actually different, that they bring something unique to the table.
It's the Marie Kondo approach to investing. Does this stock spark a unique signal? If not, thank it and throw it out.
Exactly. In the age of big data, our instinct is to hoard information. We think more data points equal better decisions. This paper proves that sometimes the smartest move is to delete data, to find the few signals that truly matter and just ignore the noise.
It's still uncomfortable, though. Holding 3 stocks feels naked compared to holding a whole index fund.
It feels risky because we confuse variety with diversity. A buffet has variety, but if all the food is poisoned, you're still getting sick. Diversity is about structural independence, and what this shows is that real independence is rare.
So here's the challenge I want to leave our listener with today. Open your brokerage app, look at your positions,
Look at those 20 ETFs or those 50 individual stocks you've picked out.
and ask yourself a really hard question. Do I own 50 different businesses? Or do I just own 50 different ways of betting on interest rates staying low?
Or 50 different ways of betting on the U.S. consumer. Because if they all rely on the same engine, you don't really have a portfolio. You have a single, very levered bet.
And that bet might be a lot riskier than you realize. Maybe it's time for a purge.
Got the friends, keep the enemies.
That's the motto. Thanks for taking the plunge with us on this deep dive.
Always a pleasure.
Check your correlations, everyone. We'll see you next time.